A few days ago, I told you the reasons to be bullish about the stock market, but the reason why so many people are still pessimistic is this is one of the most expensive stock markets ever, and it's about to break that record. I'll tell you why coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Welcome to this channel. If you are new, hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, we are into corporate earnings season. Over the next few weeks, we are going to be getting lots of earnings updates on the dismal second quarter from all sorts of companies, and with the stock market still being elevated, as these companies report awful earnings, we are going to see the price to earnings ratio skyrocket to record levels. That's right, folks, higher than those outrageous, irrationally exuberated prices back in the tech bubble. Let me tell you what this means and level the playing field. Forget about stocks for the market, or for the moment, and you know, Apple stock and all sorts of big companies. Let's just say you own, or I own a hardware store and you want to buy it. And my hardware store every year produces $100,000 of revenue. But of course, at my hardware store, I've got to pay rent. I've got to buy the tools and goods that I'm going to sell to customers. And I've got to pay employees, right? And I've got all other sorts of expenses. So those expenses every year, let's say I do a really good job managing those expenses and keep them down as far as possible, then let's say that all those expenses are $80,000. So that means my reward for taking the risk of being the business owner is $20,000 of profit every single year. And on that $20,000 of profit, I've got to pay taxes, and I've got to do some other things. But for the most part, that $20,000 is my reward for taking the risk of starting the business and running the business, okay? Now, if I'm trying to sell that, right? If I'm trying to sell this business, oftentimes, again, if we're not talking about Wall Street, if we're talking about Main Street, then I'm going to need to sell this at a price that you would be willing to buy it at. And so most times you look and say, well, if I've got money in my pocket, I'm willing to pay a certain amount of money for this business, but I would expect that it's going to provide a rate of return to me. So typically you say, well, 5 times this profit number, okay, gets us $100,000. I'll pay you $100,000 for this business, and doing so, I'll give you $100,000, right, to buy the business, and then I'll earn $20,000 a year for the next 5 years. So it will take me 5 years to recoup my $100,000 investment, and then I'll actually start making money. It will take longer because I'm going to have to pay taxes on that. So it's going to be more like 6 years of collecting those profits, hoping that everything goes well, hoping we don't hit another coronavirus or whatever, hoping that everything goes well, and after those 6 years, then I'll actually be making money on my investment. Because there's no reason for you to buy my hardware store if you're not going to make any money. And the only money you make is this profit, okay? So what this is called here is the multiple, or the earnings multiple that you will pay. So the price to earnings ratio is about 5, okay? 5 times. Now you can also see here that a quick and dirty way of calculating what's this business worth, sometimes you look at, well, what's it worth based on sales? Now, this is a crude way. You should not value a business this way because the expenses absolutely matter. If you need to now hire more people, or wages go up, or whatever, rent goes up, whatever, you need to care about those expenses. So it really should be based on earnings or profit. But sometimes you base it on sales, and you can see this is just a one-time sales. right? That's really easy. All right, with that backdrop, let me tell you what's going on. The highest multiple right here that the stock market, because even though we're talking about a hardware store and we're talking about Main Street, the same thing applies on Wall Street. If you're going to buy stock in Apple, that means you're an owner of Apple. That means you're an owner of the company Apple. And therefore, you need to care about what's the multiple that I'm paying right now. How many years will it take for me to recoup my investment? And these multiples aren't static. If people are optimistic about the market, they'll pay more. If people are pessimistic about the market, they'll pay less, lower multiples. Right now, we are about to reach record levels of multiples, meaning the stock market is about to be more expensive than it's ever been before. Is this just a flash in the pan? Because of the coronavirus, it's artificially pushed profits way down, and then profits will come back up. Or is this going to be a tough road to travel here, where corporate profits might come back, but it's going to be a long time before they get back to normal? Well, we'll see. The highest these multiples have ever been was back in the tech bubble. That's why they call it a bubble. People paid the highest multiple ever, and of course that was just not sustainable. And this multiple on Wall Street got up to 22 times, in that range, okay? Guys, currently we are at 21 times, and that's based on earnings before the pandemic really hit. We're about to get earnings reports from companies in the S&P 500 and all over the stock market over the next few weeks, and we're going to see those earnings drop like crazy. And if the stock price still stays high, we are going to just destroy that record. And this PE ratio, this multiple, is going to go soaring. One last point of alarm with this is typically on Wall Street, they don't worry about the price to sales ratio, because that doesn't really matter. But I told you the other day that Lemonade IPO was actually paying 56 times price to sales, because there was no profit. So you can't base it on a price to earnings. There was no earnings. At the worst, at the peak of the tech bubble, we were tracking how many companies were actually worth 10 times their sales, not their profit, because there wasn't any. How many companies were worth 10 times their sales? We are about to break that record right now. Today, there are more companies in the S&P 500 that are being priced at more than 10 times their sales. We have more right now than in 2001. We're very close to the record of number of companies that were valued more than 10 times their sales. That was hit in 1999. We are about to break that record as well. Not even talking about this astronomical number of times profit. I'm talking about times sales. We are about to break that record. I'm going to be sharing that with you. I mean, as we get these earnings numbers, that's definitely going to create some volatility on Wall Street. Will that actually send signs of optimism? Will the earnings not be as bad as what everyone thinks? We'll see. We'll be talking about it here, but wanted to tell you this is the most expensive stock market we've ever seen. Ever. Is it just a flash in the pan? Everything's going to be coming back very quickly? Or is this a sign again of, geez, this was bubble territory. What were we thinking? We will see. How to apply this in your financial life, guys, don't be speculative. Make sure that your overall investment approach is connected to your risk tolerance, your time horizon, and your overall financial goals. Work with your CFP to make sure that is in place. Need a CFP? You can always talk to a member of our team. Find us online, Korhorn.com. That's Korhorn with a K. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.